Good afternoon, everyone. We greatly appreciate you joining us here today. Whenever we receive a string of questions from our clients where we feel that we're not the experts on the topic, we try to bring in those experts. And that's the case here today, as we're joined by Monica Matlow with Wintrust Mortgage, Pete Santangelo with Wintrust Community Advantage, and Carrie Bartell with KSN Law. And they're here to discuss recent changes in lending requirements and how they impact your community associations, mainly the Fannie and Freddie recent guidance. We'll open up the program to questions at the end via the Zoom Q&A feature. When a speaker is not actively speaking, they will also try to answer your questions in that Q&A feature as well. We'll also email everyone a recording of this program and the slides for this program afterwards. If not today, tomorrow morning. In fact, probably likely tomorrow morning, really at the latest. January and February of 2022, and there were numerous webinars and discussions related to that updated Fannie and Freddie regulations or that guidance or that questionnaire. We certainly fielded our fair share of questions on the topic here at Reserve Advisors. However, we wanted to allow several weeks to pass to see how this would actually play out in the real world. We wanted to see what's actually going to happen with respect to this new questionnaire. And so with that background, I'd like to turn the discussion over to Monica, as she's directly impacted by these new requirements.
Hello, everyone. Good afternoon. My name is Monica Matlow and I work for Wintrust Mortgage. Today, I want to talk to you about the new Fannie Mae and Freddie Mac guidelines. Let's just talk a little bit about Fannie and Freddie. Fannie and Freddie are federally backed mortgage institutions. Mainly, they provide U.S. housing market with liquidity. They provide liquidity by purchasing mortgages from lenders such as Wintrust. Once they purchase the mortgages, they repackage those mortgages into mortgage-backed securities for sale to investors on the secondary mortgage market. This practice is very beneficial to mortgage markets. This means that there is a steady supply of money. Wintrust does the mortgage, Fannie or Freddie buys it from us, and we have money available to lend to more buyers. Fannie and Freddie package the same mortgage into mortgage-backed security, sell it on the secondary market. They get their money back and have money to purchase mortgages from us. This liquidity is important for the mortgage markets to work. You can go to the next slide, Todd. To the next, yeah, this one is fine. Both Fannie and Freddie have guidelines that need to be followed by banks and loan originators such as Wintrust. If we follow the guidelines, we can sell our loans to Fannie and Freddie or to other investors that follow these guidelines. A lot of you may remember the collapse of the Champlain Tower in Surfside, Florida last year. It was a big tragedy and hopefully something like this won't happen again. I read a little bit about what happened and the problem was mainly deferred maintenance. Project had lots of issues and of course to address these issues you need either money in the saving accounts or you have to raise HOA dues or do special assessments, and unit owners weren't really keen on the special assessments or higher HOA dues, so they never really voted on special assessments. They never really addressed any of these issues at the board meetings. And in the end, we all know what happened. The entire tower collapsed and a lot of people died. Therefore, Fannie and Freddie decided to make a special set of guidelines that would mitigate the risk in the condo projects with deferred maintenance. In a way, it is not a bad thing. This makes lots of condo associations aware of their deferred maintenance issues. And hopefully these associations can take some steps to resolve these issues. So the guidelines changes address significant deferred maintenance and unsafe conditions, special assessments, there's a condo project manager unavailable status guideline and reserve requirements guidelines. Let's talk a little bit about significant deferred maintenance and unsafe conditions. Fannie Mae created a new addendum to their condo questionnaire. This addendum has 2 pages and it has around 10 to 13 questions. And all of these questions ask about mainly significant deferred maintenance and unsafe conditions and about special assessments. So significant deferred maintenance includes deficiencies that meet one or more of the following criteria. It's full or partial evacuation of the building, or the deficiencies are severe enough to affect the safety, soundness, structural integrity, or habitability of the condo building. Building needs substantial repairs. Some of the major building's components are not in a good working order, such as foundation, roof, electrical systems, HVAC, or plumbing. Additionally, if project fails to pass any inspection, it is deemed unsafe. In city of Chicago, we have lots of condominiums with city code violations. And anytime we see something that has city code violations, we cannot warrant the condominium. Usually, any of these issues can be only cleared if all the work to do like the significant deferred maintenance and unsafe conditions that needs to be done is done. You can go to the next slide. Special assessments. Any current or planned special assessments must be reviewed, even if paid in full for the subject unit. We are required to document the loan with the following: the reason for the special assessment, the total amount assessed, and repayment terms. We have to get documentation that supports there is no negative impact on the condominium, and we need to qualify the borrower with any outstanding payment. This is all in Fannie Mae and Freddie Mac guidelines. So if there is a special assessment that is not going to be paid off at the closing, if somebody is buying a unit, we have to get the amount of the regular monthly HOA dues and special assessment dues, add everything together, and qualify borrower with both payments. So this goes for special assessments. Special assessments, usually, when I see them, it's not a deal killer. Usually when I see special assessments to go hand in hand with city code violations or some kind of like different maintenance issues, that's when I say, okay, this project has lots of problems. But if I see regular special assessments just that address regular maintenance items, like roof is nearing its end life and they need to replace it, and they do special assessment to do that, I'm usually fine with those special assessments. You can go to the next slide, please, Todd. Then there is a condo project manager unavailable status. Fannie Mae is using a software which is called CPM, Condo Project Manager. We lenders, we can search this software for any condo project. If the condo project shows as unavailable in this software, we are not allowed to sell the loans in this condominium to Fannie Mae. This goes for all types of review, for limited and full. So even if somebody has 50% down and it's a primary purchase and the condo shows as unavailable in CPM, we cannot do the deal. Fannie Mae usually changes the status of projects in CPM to unavailable when they become aware of any issues in the condo project. There could be deferred maintenance issues or other issues listed in the selling guide, such as single entity, litigation, condo is a condo hotel, etc. I checked, and there are about 950 condominiums listed as unavailable nationwide. Most of them are in California and Florida. In Illinois, we have around 13, so we don't really have that many. And again, this status can be changed if the issue is cleared. Like, for example, there is construction defects litigation and the litigation gets resolved. An association has some documents to that regard. They can email everything to Fannie Mae, and Fannie Mae does change the status of the condominium in CPM. We can go to the next slide, the reserve requirements. Fannie Mae, for all full reviews, they need budget that shows at least 10% reserve funding. This means that at least 10% of HOA dues must be transferred towards the reserves. So if you collect $100,000, usually 10,000 of that should be transferred to the savings account. And if we had budget, like all the guidelines said that if it was less than 10%, it was still okay if there was a reserve study that supported that budget. But right now, Fannie Mae suspended it. The only thing they want is the budget that shows 10% or more reserve funding. And if there is a reserve study that would support less than 10%, you can take those documents and again, email everything to Fannie and ask for exception. but that would have to be like a special exception where Fannie does the review. It's called PERS review, and Fannie usually charges money for PERS review. And I just want to talk a little bit about Freddie Mac. Freddie has similar guidelines when it comes to deferred maintenance and special assessments. Freddie doesn't have any special condo software, so the condo project manager unavailable status doesn't really apply to Freddie. And also, Freddie didn't make any changes to the reserve requirements. We can still rely on budget and reserve study if the budget shows less than 10%, but the reserve study says it's okay. And basically, also like Fannie and Freddie, they both do waivers. And Freddie allows you to apply for a waiver for deferred maintenance. However, Fannie doesn't. They don't do any waivers for deferred maintenance. So this would be all from me. And if anybody has any questions, I can answer them later or right now in that question and answer feature.
Thanks, Monica and Todd. Very good information. And as Monica stated, so, why are we here? I think it's mainly because of what happened to Surfside, and also, in Miami, that was really a tragedy. But is this an overreaction? I think I'm going to be discussing, exactly what they're asking for, and whether or not, we don't already have a lot of this information. I belong to CAI and FCAR. CAI is the Community Association Institute. FCAR is a foundation for community association research. And they've collected a lot of data, a lot of the information pertaining to what's being asked for and how it's impacting the community. And they gathered this information because they have tried to go back to Fannie Freddie and see if they could either eliminate this questionnaire or push it off for a year, because I think a lot of associations didn't really have time to address these questions that they're asking for. So some of the questions they asked is, does your community have a reserve study? And 60% of those answering said yes, 22% said not sure. Does your community have a plan to fund repair and replacement of major components? 75% said yes, and 16% said not sure. Do you support annually investing in your community to build a fund for future repair and replacement? 71% said yes, 13% said not sure. Again, looking at that information, a lot of these associations are already doing their due diligence. This information was compiled from associations across the nation. CAI is also doing an impact survey, and I know we'll give out the link to the CAI information, which I think is very good information. Kind of goes over how this legislation, these changes, I should say, this questionnaire is impacting us from Fannie Freddie, and also gives you a nice guide for navigating through this. Some of the questions they're asking to try and get more information. So I encourage you to go to this website and take a look at it and complete the questions that they're asking. Some of the sample information they got from the survey is, have your clients experienced an impact from new regulations in your community? 43% said that they've seen a delay in lender approval. 28% have said lender denial and the sale did not go through. And 19% had no issues. They also asked, which of the following you experienced as impact from the new regulation in your community? 30% said they've seen a delay in approval. 28% have said none. And 22% said they've had lender denial because the sale didn't go through because they couldn't answer the questionnaire. So I think, this definitely is impacting sales within the community. And I do recommend, again, I'm not an attorney, but I recommend you completing the questionnaire, using a lot of disclaimers, using information and documentation. The question, contribution to reserves. This is an important component, especially if you're going to pay for an association loan request from this. This is, there's only 3 different ways that the association could really raise funds to pay for an association loan. That's by their contribution to reserves, their special assessment, a loan, or a combination of all 3. A reserve study. I think everybody, this is vital. Everybody should have a reserve study. I know the Illinois Condo Act asks and requires for reasonable reserves. And I think here in Illinois, how do you establish what's reasonable? A reserve study is an important component because it's a third party contractor or vendor that's coming in and giving you what the useful life is of the components of your common elements. Special assessments, as I mentioned, I don't think you should be afraid of implementing a special assessment, but you should have information and documentation as to why you're doing it. And I think where sometimes you're going to come into trouble is if you've been deferring maintenance, and this special assessment is really to cover a lot of deferred maintenance that's being done. So how do you prepare for your projects? I think with a lot of common sense and caution. Again, you have to do your due diligence, make sure you have your ducks in a row. And you could change the slide, bank's perspective. Don't shoot the messenger. There's a difference between an association lender and a mortgage lender. But from the association standpoint, we're lending to your association, whereas the mortgage lender is lending to someone trying to buy or purchase within your condominium association. We are just trying to comply with what has been edicted from Fannie and Freddie. We're not creating these questionnaires. If anything, we wish they weren't there. But it's something that we have to deal with and something we have to move forward with. So we have to proceed with caution. I've had a couple of, I know Monica mentioned a couple of associations that have been sanctioned in Illinois, and some of you that are in Illinois may know who I'm talking about in my example. But 2 examples we've had is garage repairs. Here in Illinois, in our environment, you have cars coming in and out of garages. You have salt, which gets brought into the garages. And the membrane of the garage has to be replaced, and sometimes there may be some cement that has to be repaired or replaced. We looked at one loan to an association, and the association and the garage were 2 separate associations. Yet the condominium association and the residential association was sanctioned by Fannie Freddie because of the work that was going on in the association, which was the garage below them. This loan for, because they were sanctioned, this loan did really not go through because we just, with the sanctions in place, we would not even want to touch it. However, there was another garage that we looked at, same thing. And for whatever reason, Fannie and Freddie looked at this. They did not sanction the association. We gave the loan to the condominium association. The garage got done. I think the difference between the 2 was, again, the way they went about doing the work. The one garage association did repairs every 3 to 5 years, whereas the other one put it off. It was a lot of deferred maintenance. And when they went for the loan, and also when someone tried to purchase, they found out this work was going on, and Fannie Freddie sanctioned getting the work done. So my recommendation is don't put off tomorrow what you should do today. Boards still have a fiduciary responsibility to do what is right for the association. This is your home, and you do have to get the work completed. Yet if you're in an association that has been putting off repairs because of the expense, you may have an issue with these under the new regulations. So how will association financing change? Banks are still going to review documents that are lending to condominium associations. They're still going to ask for the same items, which is your budget, your financial statements, delinquency report, information on the project, but they may now ask you if you've been sanctioned by Fannie or Freddie, if you are on the non-available list, and that may impact moving forward on getting a loan for your association. The reserve study, this is, as I stated, vital. What you may see is more difficulty getting a loan if you don't have a reserve study. I know in the past, we would always ask for a reserve study. However, if the association did not have one, we would look at what type of work was being done, and we'd make a decision to move forward and document not having the reserve study. Cash flow analysis. This is something I think that will help giving information and documentation. And banks that lend to associations look at the cash flow that's available to the association while the loan is in place. So we'll look at the reserve contribution or special assessment funds, and then take out the payment on the loan, and then also see what is available in reserves, and is that going to be sufficient while the loan is in place to handle any other projects that may come up. Again, this is a vital component, and if you could show that while the loan is in place, even with a special assessment, you still have sufficient funds left to complete projects while the loan is in place, that's a plus, that's a positive. What if we are listed as unavailable status? It's going to be difficult for you to get an association loan. Most likely, there's going to be signs of severe lack of neglect. What options do you have? This may seem harsh, but I know we've seen a lot of condo deconversions in Illinois here. There may be investors that may have to come in, purchase the actual association, deconvert it, and turn it into a rental building. That's all I have to say. Carrie Bartel from KSN will enlighten you on the legal side. Carrie, thank you.
You were just talking about how we start every Zoom with unmute, right? And even better, I get to start my legal presentation with a disclaimer. So I'm just, living up to the reputation. So just to kind of go over the disclaimer real quick, I just want to be clear that my frame of reference, and I'm only licensed in the state of Illinois. So we'll talk about things generally, but understand that my license is only in Illinois, and the Illinois Condominium Property Act and the related statutes are really my frame of reference. All right, so let's dig in. So the lender questionnaire, we initially, certainly when the Fannie Mae guidelines came out, we're receiving a lot of questions from our association clients as to whether or not they needed to do, fill out this additional questionnaire. Can't we just say, refer to this document or refer to that document? and see if that flies. So the problem is that these requirements are being dictated by Fannie Mae and now Freddie Mac. And as Monica and Pete both alluded to, even if the buyer in your association is going through a conventional mortgage, that conventional mortgage wants the ability to be able to sell to Fannie Mae and Freddie Mac. So what we're seeing is that these questionnaires are coming in as additional requirements of every lender. The other thing that, just real quick, because I saw a couple of questions in the Q&A, but I also think it's important to give you the context. The Fannie Mae guidelines provide that the new questionnaire has to be provided and responded to for any association that has, quote, 5 attached units. Now, that's all it says with regard to what qualifies as far as attached or what 5 units have to be attached. I suspect, hopefully, we'll get some clarification on that. But what I'm seeing right now is that lenders are taking the position that pretty much any association that has more than 5 units, whether they're attached up and down, side to side, over several buildings. I know there was a question, well, we have 4-unit buildings in our townhome association. If you have more than 1 building, though, they're going to consider that as 5 attached units. It also applies to any condo, townhome association, or PUD. A PUD is a planned unit development ordinance association, and it's typically a homeowners association or can even include a master association. What I'm finding is that lenders are being more inclusive as to what associations fall under that definition rather than sticking to the strict definition. They're being overly cautious. So legal ramifications and liability. That, of course, is the whole ball game here. Fannie Mae and Freddie Mac are trying to limit their exposure to providing a loan to an association that is essentially not properly funded or properly maintained. As a result, these are additional disclosure requirements that in Illinois, it's called a section 22.1 disclosure and a paid assessment letter. Your statute in your state may have a different number attached to it, but it is that disclosure requirement where the association has to talk about all the things relative to the association so that a buyer is well informed. One of the things that I keep reminding my clients is that the purpose of this disclosure form, in addition to our section 22.1 disclosure and the PAL, is that the lender, the buyer, and the seller are relying on the accuracy and completeness of the statements provided by the association. It is a legal document. The disclosure form has to be signed and attested to. So it is not just another form, that you can kind of be flippant about. If the association or management is signing that document, you are the ones that are asserting and confirming the accuracy of those statements and the completeness of those statements. So, as Pete said, we are recommending to our clients that the association respond to the questions in full and that they compile all of the documents that are supporting their answers. That all needs to be provided to Freddie Mac and or Fannie Mae. You have to understand too, is that there are actual damages at issue. Sometimes we have legal requirements that a board of an association has to do this or should do this, or there's fiduciary duty requirements. But if the board doesn't follow those strict requirements, there may be no damages that result. So it's hard to quantify what is at issue. In this instance, there are actual damages at issue. An owner is purchasing a unit in the association and a lender is providing funding for that purchase based upon the statements that you're making in that disclosure. Note also that it may impede an association's ability to collect special assessments from the buyer once they become an owner in the future. So we really want to make sure that our answers are accurate and complete. Okay, next slide, please. So best practices. I think one of the really wonderful things about Todd and Reserve Advisors putting this presentation together was to be able to provide all of you with sort of what we're seeing in the industry now that we're just over 3 months into this process. And as I alluded to before, Monica and Pete also brought up, we're seeing these lender questionnaires for pretty much any mortgage, and owners, board members, managers are concerned and hesitant to be the ones that sign the document. What we are recommending to our clients is that they do seek legal counsel to address this new lender questionnaire, those pages 6 through 8 on the Fannie Mae questionnaire, and let them help guide you through the questions and how to answer them. This is a great opportunity for the board to rely on their experts, and that includes engineers, architects, contractors, reserve study professionals, and your attorneys. The attorney can assist you in helping to understand both the scope of the questions and then how to answer them based upon the information that the board has from the reserve study, from engineering studies. In the city of Chicago, we have to have critical exam, facade exam studies. Those are all documents that are going to go into this response. What we have done in our office for our clients is we have set up a program where we actually do our own questionnaire to the board and the manager to help us understand what the answer should be to the questions. We ask for all supplementary documents to include the budget, reserve study, any special assessment information, any pending loans that they have, any engineering studies, sort of all these things we've been talking about. All of those are sent to our office. We then review all of that documentation, and our office is the one that actually signs the questionnaire form so that we are taking on that liability for the association. Next slide. So some best practices and what I've seen sort of ease this project or process for our clients is to make sure that you're doing some proactive steps with respect to maintenance and budgeting. A lot of these things we've talked about ad nauseum, but they're the critical parts. So I think the most beneficial thing that you can do as a board or even as a manager counseling your board is to position the community to address projects in a timely manner. This will help to minimize the risk of deferred or scheduled maintenance, safety concerns, obviously most important, and then also to help plan for your financial budgeting and strategy for both on a short-term and a long-term basis. The best way to do that is to have a current reserve study. If you have a reserve study already, but it's 3 or 4 or 5 or 6 years old, get it updated. A reserve study, in my opinion, should be something that the board budgets for as part of their regular course of business. So it is important to plan for that expense, much like you would an audit or something like that. Fund your reserves to that of the association's needs. If you have a reserve study or other engineering studies or information that show that your reserves need to be higher than 10%, you should be funding that if you can. In Illinois, the Illinois Economy and Property Act says that the board, as Pete said, should maintain reasonable reserves. There are several factors that can go into that. One is the reserve study, but then you get to balance that reserve study number versus what is the impact on the assessments and the marketability of the units, the association's ability to get financing, what other financial impact is going to be imposed upon the association in the future, you can balance it a little bit, but try to get as close to that reserve funding goal as you can. Make sure that you're doing a long and a short-term capital project plan. You know, associations that know that their roof is going to be in need of replacement or significant repairs in 10 years, start planning that now. And how is that going to fit in with all of the other projects that you will have associated with the building? Last, present a sound financial plan to cover the costs associated with the work. Again, that can be some combination of your budget, reserves, financing options. And then you really need to, if you don't already, have a collection policy in place so that you make sure that that income stream through assessments and special assessments is coming in, and that you're fully funded from that side as well. All right, so again, I've kind of alluded to most of this before, but what we're finding on our side at least is that lenders are not accepting simple answers. They want to see the documentation, and the answers to those additional pages and the additional questions need to be fully answered. Again, provide all of the supporting documents. This includes the good documents and the not so good documents. You know, I've had associations say, well, our reserve study says we don't have to do the roof for 7 years, but oh yeah, there's this engineering study that really it's going to be 5 years. We need to provide all of that documentation. Again, these questionnaires have legal import, and so there's liability that attaches to it. You need to be accurate with it and up to date. That's the other thing that I think is important. Make sure that you're providing the most up-to-date documents. Again, the reserve study may be 3 years old, but if you have an engineering study that's a year old that provides a different opinion, it's important to have all of that information for whomever is reviewing and providing the answers to the questionnaire. The last thing, which I think is a frustration, I know probably for all of us, including board members and managers, is to give your owners a realistic timeline of the impact on the timeline for closings that is happening as a result of these additional questions. You know, that idea of a quick closing is probably not going to happen if the Fannie Mae or Freddie Mac questionnaires are involved. It takes time for the board, management, your attorney, or whomever is preparing that questionnaire to go through to compile all the documents, review it, and then provide the answers. That is also going to take more time, I would imagine. Pete and Monica can correct me if I'm wrong. It's going to take longer on the lender side too. They have to review that documentation. I know with interest rates being projected to go up, I'm seeing more and more requests in the last month or two to, oh, well, we have a closing tomorrow, or we need to refi by Friday. Can you get it back to us? That's probably not a realistic expectation. And I think one of the things that you can do as a board or a manager to sort of calm everybody down is to, again, notify your owners as to what's going on and that they need to be a little bit more patient with this process.